Welcome to the deep dive, the place where we don't just skim the headlines. We really crack open the source material so you can be instantly well informed.
Yeah, and today we're tackling, well, it's a big one, Realty Income Corporation, ticker O, specifically their latest quarterly filing, the Q3 2025 10Q.
Exactly. Our mission today is to synthesize all this dense financial data, figure out how healthy their massive portfolio really is, understand their growth strategy, and, check the state of their capital structure.
And this is essential because Realty Income, the monthly dividend company, they're kind of the gold standard for stability in this triple net lease world.
Right.
So we need to look past the surface, get into the numbers, and ask, how does this huge, stable company keep growing so aggressively, especially now with higher rates? And what's the trade-off?
Okay, but before we jump into the weeds, let's just quickly frame why realty income matters so much, particularly for income investors. It's seen as the ultimate defensive play, right?
Oh, absolutely. It's pretty much the definition of dependability.
Yeah.
You got an S&P 500 dividend aristocrat status,
Which means
increasing its dividend for over 30 straight years. Impressive stuff. And get this, 664 consecutive monthly dividends declared since they started. Their whole mission is right there. Dependable monthly dividends that go up over time.
that's quite a track record. And the Q3 2025 results, just glancing at them, they suggest that engine is still running strong.
Definitely. The top line numbers look robust. Net income available to common stockholders. $315.8 million in Q3 2025. That's a significant jump from $261.8 million in Q3 last year.
Big increase.
Yeah, and total revenue hit $1.47 billion for the quarter. So, looks stable on the surface, but we need to see how they generated that income. Where's it coming from?
Okay, let's unpack that core portfolio then, the actual real estate, because stability really comes down to the quality of those assets, right?
Precisely.
As of September 30th, 2025, we're talking about, 15,542 properties, leased to over 1,600 clients, 92 different industries. What tells us this portfolio is truly rock solid?
Well, first thing you look at is just, are the lights on? Occupancy. It's remarkably high at 98.7%. Think about it. Out of over 15,000 properties, only 204 were available to lease or sell. That's near perfect. That occupancy level is the bedrock of their cash flow.
And tenants tend to stick around for a long time, yeah. It's inherently sticky.
Correct. The weighted average remaining lease term is around 8.9 years. That means predictable revenue, long-term streams, and they're choosy about tenants, too. About 31.5% of their total annualized base rent comes from investment-grade clients. Big, stable companies.
Okay, now here's the part that might make some people pause. Roughly 80% of their business is retail. And you hear retail, you think, well, recessions, e-commerce, risk. How do they make that work?
It's all about which retail. Their strategy is purely defensive. They focus only on businesses that tend to resist economic downturns and, aren't easily replaced by online shopping.
Okay.
Look at the numbers. 91% of their retail base rent comes from clients doing essential services, selling non-discretionary goods, or hitting a low price point.
So businesses you pretty much have to visit no matter what's happening with the economy.
Exactly. Think 7-Eleven for essentials, or Dollar General, where low prices are even more attractive when inflation's up. These aren't mall stores. They're usually freestanding spots, generating steady income good times and bad.
Right, that makes sense. Which brings us to something I found really fascinating in the filing. Maybe the clearest sign the assets themselves are strong, that rent recapture rate.
Ah, yes. This is a key signal of asset health. When a lease ends, what happens? Tenant leaves, you renew, or you find someone new. For the first 9 months of 2025, Realty Income's rent recapture rate was 103.5%.
103.5%. That's pretty amazing. So for listeners, that means when leases expired and they renewed them or released the space, the new rent was, on average, 8.5% higher than the old rent.
Exactly. They're getting built-in rental growth from the existing portfolio.
Without spending much extra capital.
Right. It proves their initial property selection was smart, and that market rents for these kinds of defensive properties are actually increasing nicely. This isn't just holding steady, it's organic growth. And we see that backed up by the 1.3% growth in same-store rental revenue over those 9 months. High occupancy plus getting more rent on renewals, that's stability defined.
Okay, so that internal engine is humming. But REITs, they're complicated beasts with depreciation rules and all that. Net income doesn't tell the whole story for dividend safety. We got to look at cash flow. What do the non-GAAP numbers, the FFO and AFFO, tell us?
Right, depreciation is a non-cash charge. It makes net income look lower than the actual cash coming in. So we look at funds from operations, FFO, and even better, adjusted funds from operations, AFFO. AFO is really the key metric for figuring out how much cash is truly available to pay out those dividends month after month.
And what's the AFO story for the first 9 months of 2025?
Diluted AFFO per share came in at $3.19. Now that's up from $3.14 in the same period in 2024.
Okay, steady growth.
It's incremental, yeah, but consistent. It shows that operational strength is translating directly into shareholder value, and that AFO growth is exactly why they could increase the dividend 5 times during 2025, keeping that dividend aristocrat streak alive and well.
They're not just paying it, they're covering it comfortably.
Absolutely. The AFFO payout ratio is healthy, somewhere around 75.5%. They're retaining cash, too.
So the core business is solid, nearly full, raising rents, which kind of forces them to look outwards for significant growth, doesn't it? How does a giant like this, already owning 15,500 properties, keep finding new deals to buy?
Scale and geography. They invested a huge $3.9 billion total in the first 9 months of 2025.
Wow.
And $1.4 billion of that was just in Q3, with a pretty attractive initial weighted average cash yield of 7.7%. But the real headline here isn't just the sheer volume, it's where the money went.
Yeah, I noticed that geographic shift, too. It's pretty striking in Q3. Looks like a deliberate move beyond just U.S. deals.
It is dramatic. In Q3 alone, about $1.0 billion in investments were international, mostly Europe. Compare that to only $380 million invested domestically in the same quarter.
$1 billion internationally versus less than $400 million here.
Exactly. It strongly suggests the U.S. triple net market might be getting too crowded, maybe too pricey for them to hit their yield targets, so they're pushed overseas to find those returns.
But doesn't piling $1 billion into international deals, mostly Europe, you said, add new risks? Currency swings, different regulations, needing specialized teams over there. Does that dilute the sort of rock-solid predictability we were just talking about with their U.S. portfolio?
Well, that's the core tension, isn't
Yes.
it? It absolutely adds complexity, no doubt about it. But look at that 7.7% cash yield they got on those key 3 deals. That's quite attractive in today's environment. Management's clearly thinking the higher return justifies taking on that bit of extra, let's say, operational friction. It's an offensive play to keep the growth engine revving despite rising capital costs, which we'll get to.
And they're not just buying, they're actively managing the portfolio. Selling properties, too. Sold, what, 268 properties in 9 months?
Yep, they call it capital recycling. Sold those properties, brought in $424.2 million in net proceeds, and importantly, booked a nice gain of $110.2 million on those sales.
So they're pruning.
Strategically, trimming properties that maybe don't fit the profile anymore or have hit maturity, taking the profits and plowing that cash right back into those higher-yielding deals like the ones overseas.
Okay, let's shift to the engine room, then the capital structure. All this growth, $3.9 billion in deals, needs fuel. How are they funding this massive appetite?
They live and die by their access to capital markets. That means constantly issuing both debt and equity. As of September 30th, their liquidity position looked really strong, about $3.5 billion total.
Okay.
That includes cash on hand, plus something called ATM forward equity proceeds.
All right, ATM forward equity, can you break that down quickly? Sounds like jargon.
Sure. ATM just means at the market. Basically, they've already arranged to sell stock at current prices, but the deal settles later. So they've locked in that equity funding for future deals.
Ah, okay, so they know the money's coming.
Right. It gives them confidence to commit to acquisitions. That was about $864 million they expect from that, plus another $2.2 billion available on their credit lines. That's a lot of financial flexibility.
Plenty of dry powder then. But that expansion means they're managing a pretty hefty debt load. What's the snapshot there?
Total debt outstanding across their credit facilities, term loans, bonds, was $28.7 billion.
Oh.
But they managed it quite conservatively.
Or so.
The weighted average maturity is decent at 5.6 years. And crucially, 93% of that debt is fixed rate. That's their main shield against rising interest rates.
And they're still tapping the bond market, even recently.
Yeah, shows investors still have confidence. They issued some unsecured notes back in Q2 2025, like $600 million at 5.125%. And then even after the quarter ended in October, they did another $400 million issue, this one due 2029, at a rate of 3.950%. This constant cycle of refinancing and new debt is key to funding growth.
Again, the market trusts this approach, right? That's why they keep that investment-grade credit rating. What are the safety metrics supporting that?
The key one is leverage.
Yeah.
We look at net debt compared to their adjusted earnings EBITDA, as it's called for REITs. That ratio held steady year over year at 5.4x.
Which is considered safe territory?
Yes, firmly investment grade. And their ability to cover their debt payments, the debt service coverage ratio, is super healthy at 4.6x. The minimum required by their loan agreements is only 1.5x, so they have a huge cushion.
Okay, balance sheet sounds incredibly solid, which is great. But let's circle back to that tension we mentioned. Costs are rising. Their total interest expense jumped by, what was it, 13.1% for the 9 months ending September 30th? That seems significant.
That 13.1% increase is definitely the main headwind you see in the numbers. It's driven by two things. Simply borrowing more money overall because they're buying more properties and, well, the fact that new debt costs more today than it did a couple of years ago. It's a real cost that directly eats into potential AFFO growth per share.
So, if borrowing is getting more expensive, what does that tell us about how confident management feels? They must think the deals they're finding are still good enough to overcome that higher cost.
That's exactly the signal they're sending. They seem absolutely confident they can still find investments with a profitable spread over their cost of capital. In fact, they actually raised their investment volume guidance for the full year 2025.
Raised it.
Yeah, bumped it up to about $5.5 billion from a previous estimate of $5.0 billion. So they're pressing harder on the accelerator, even though the fuel, the capital, costs more.
Okay, so wrapping up our deep dive into Realty Income's Q3 2025 filing, the picture that emerges is really one of, maybe, contrasts. On one side, you've got this incredible operational stability, that 98.7% occupancy, the 103.5% rent recapture, that's stellar performance.
Truly best-in-class internal metrics.
But on the other side, you see this aggressive push into international markets and that noticeable uptick in their cost of capital, the interest expense.
Right, and pulling it all together, management nudged their full-year 2025 AFFO per share guidance slightly upwards to a range of $4.25 to $4.27. That signals they believe the new, higher-yielding investments will more than offset the higher financing costs. They're still delivering on that core mission, growing the dividend.
So let's leave you with this final thought. We saw that remarkable internal growth signal, the 103.5% rent recapture rate. It proves their existing assets are healthy, rents are rising organically. That's powerful. But we also saw the external pressure, the 13.1% jump in interest expense. Looking ahead, what should you focus on more? Is it the stable internal growth shown by that recapture rate? Or is it the rising external cost of capital that will ultimately determine the sustainability of that famous monthly dividend growth, say 10 years down the line? Which force wins out?
It really is that classic REIT tightrope walk, isn't it? Balancing internal strength against external financial conditions. And for Realty Income right now, that tension seems clearer than ever.
Thanks for diving in with us today. We'll catch you next time.